best practice. The other proposed amendment is of the definition of the individual retirement fund. This also, there was an amendment under the Tax Laws Amendments Act, which affected this definition because previously, or even currently now, the Income Tax Act defines a registered pension scheme to be a scheme registered with the Commission of Domestic Taxes. And there were rules under this act that guided that process of registration. But now, because the registered pension scheme are no longer registered with the Commission of Domestic Taxes, these rules have been made redundant, so we no longer need them. So there's a need to review the definition of the term individual retirement fund to remove reference to the income tax retirement benefit rules. And maybe we can mute those who are talking so that we can, and if I'm too fast, Mandy, maybe you can alert me. Because I know the income tax proposals are many, so I need to move fast, a little fast, and then maybe we can clarify at the end of the sessions if there's need to clarify any area. So that is it for individual retirement fund. So the other proposed deletion is on the definition of compensating tax, which was also repealed in 2019. So we no longer have that term in the Income Tax Act. So there's need to remove it wherever it is in the Act. Also the issue of tribunal, because the tribunal also moved. Now it's under the judiciary. And most of the things are also covered under the TPA, anything to do with the tribunal. So it's no longer required in the Income Tax Act. Also venture capital. That definition of venture capital since the venture capital was repealed. So it's a cleanup on that aspect. The other proposal under the finance bill is to review and to expand the scope of the definition of related person. The Income Tax Act has several definitions of related person in different areas of the Act. So the bill proposes to just have one definition under Section 2, which will apply across the all Act. I think under the 8th schedule, there's a different definition. So we just the bill proposes to have just one definition of related person. The other proposed amendment is to delete multiple definitions of related. So that one I've already explained. The other proposal is to increase the tax-free limit of per diem allowance for employees in the private sector from 2,000 to 10,000 shillings. I think the public sector has been reviewed. The one for subsistence and traveling allowance for public sector has been reviewed regularly. So there's need to review the subsistence, traveling, entertainment, or other allowance in respect of a period spent outside the usual place of work while on official duties, also for private sector. So that is the proposal, also just to address the issue of inflation over time and all that. The other also proposed amendment under the finance bill is to remove the word. There's a section that talks about a husband. So there's need to remove that term and replace it with spouse. It's under the pension provisions. So that one is basically just so that the provision is gender neutral, to clarify that either gender can contribute pension. Also, another amendment to the provisions relating to pension, because following the exemption of pension benefits by the Tax Laws Amendments Act 2024, as you are aware, the Tax Laws Amendments Act changed the taxation of pension. So it exempted all pension payments from tax, including the lump sum pension payments. However, some provisions were previously exempting lump sum pension payment from tax were not deleted. So this proposal is to remove those provisions that provide for tax exemption on lump sum pension payments and to make it very clear. So as that was effective 27th December 2024, that is when all pension payments from tax became exempt. So it's more of just to align it. It's a consequential amendment to make it clear, to avoid confusion. The other proposed change is to amend Section 10 of the Income Tax Act by adding supply of goods to public entity and sale of scrap as payments subject to income tax. As you're aware, also the Tax Laws Amendments Act introduced withholding tax on payments. Those two payments, supply of goods to public entity and also payments on for sale of scrap. So Section 10 is the deeming section for withholding taxes. So that one is just to align it because now it's subject to withholding tax. So to make it clear and to clarify and to align the provisions with the broader framework which of withholding tax. The other proposal is under the Significant Economic Presence Tax, also which was introduced under the Tax Laws Amendments Act 2024. So here, the proposal is it requires that only non-residents, the provision on Significant Economic Presence Tax requires that only non-residents with an annual turnover of 5 million and above are subject to this tax. I know it's difficult to establish with certainty which non-resident entities have reached that threshold of 5 million, since they are not required to file returns in Kenya. So there's that proposal to remove that threshold. That is the second part of the proposal. The first is just also to broaden the scope so that it includes services offered through the internet or an electronic network. The scope of the Significant Economic Presence Tax. The other proposal is also to introduce the requirement that the minimum top-up tax be payable by the end of the 4th month after the company's year end. This one was also introduced through the Tax Laws Amendments Act 2024. But unfortunately, the due date was not included. So to address this, the bill proposes to provide the due date to be the end of the 4th month after the end of the accounting period, which also aligns to payment of balance of tax. The other amendment is under Section 15. This one's that deals with allowable deductions. So the first one is the proposal to allow the total cost of low value items such as utensils, linen, and industrial tools in the first year of use. So currently, the Commission now provides guidelines for the period to deduct these low value items. Usually it's 3 years, which taxpayers had asked the government to reduce to 100% investment deduction in the first year of use. So that request has been considered, and the proposal is basically to specify that the total cost of these low value items, such as utensils and industrial tools, will be deducted in the first year of use. The other proposals, the others that follow mostly are also to do with to just comply with it to the national tax policy and to the medium-term revenue strategies to reduce tax expenditure. So there's that proposal to remove the deduction of the cost or value of standing timber when calculating taxable income. Also, there's also the proposal to delete the provision under Section 15 that excludes 1/3 of employment income from tax for non-citizens working for approved regional offices of non-resident entities. That Section 15, I think 2R, It allows a one-third deduction of employment income for certain non-citizen employees of non-resident companies who are in Kenya. So we propose, the finance bill proposes to delete that, so that now they also, to ensure uniformity in the treatment of all employment income. The other proposal is to allow expenditure incurred in construction of a public sports facility, but remove expenditure incurred in that year of income by a person sponsoring sports. This one is just to promote the development of sports facilities around the country. And also the other amendment that is proposed is to allow mortgage interest deductions on loans used to construct residential houses. Currently, persons who take a mortgage to purchase or improve premises that they are occupying are allowed to deduct of a relief of up to 360,000 per annum or 30,000 per month on the interest payment for the mortgage. But now when you take a loan for construction, it has not been the case. So the bill proposes to extend that relief to a mortgage interest also taken for construction of a residential house. So I think that is clear. So the next proposal is to delete the provision providing for capital losses deduction against future capital gain. So there are gains resulting from the transfer of property. Other than shares, those ones are subject to tax. But where the transaction lead to losses, the losses should not be carried forward from one transaction to another, because the nature of the transfer is of each transfer is not related to the next. That is what this amendment seeks to do, so that to provide that independency of these transactions and to disallow the carry forward of losses from one transaction to another. Another amendment is the reintroduction of the limit of carrying forward of tax losses to 5 years. As you're aware, the current provisions under the Income Tax Act allows a person to carry forward tax losses from business indefinitely. But you also know that the Tax Procedures Act also limits the time to maintain records to only 5 years. So there's been a bit of inconsistency, because now it brings challenges in verifying the records, as taxpayers are required to maintain it only for 5 years. So this proposal will ensure time for keeping records and prevent indefinite carry forward of losses. So the bill that proposes to carry forward the losses to be limited only to 5 years to align to that period, the 5-year period of maintaining records. So the other one is under is a cleanup, specified sources of income, reference to 7 amended. And one of the specified sources of income, I think, was about the issue of wife's income, which was deleted in 2023. So there's this proposal to remove the word 7, so that every time the specified sources are amended, there's no need to change the numbering. So that's also like a cleanup. The other proposal is to clarify on the country-by-country reporting, that requirement under Section 18, where there's more than one constituent entity of a multinational enterprise who are resident in Kenya, by stating that the M&E group may designate one of the entities to file a country-by-country report in Kenya. So this one is just basically to confirm that, and to where the group has more than one entity, that one of those entities may be designated as a constituent entity, so that it files that report. However, the Income Tax Act, is not clear on whether the designated entity becomes a surrogate parent entity when it files a country-by-country report. So therefore, the bill proposes to clarify that where that constituent entity is designated, it does not automatically become a surrogate parent entity. The other proposed amendment is also still under Section 18 to delete, there is a duplication there. There's Section 18D9 and also Section 18 capital D 1A contains the same, somehow talks about the same criteria to be met in order for a constituent entity of a multinational to be triggered to file a country by country report. So it's duplication, so it's creating confusion on which provision should apply. So that one we just, the bill proposes to have one, to maintain one provision. The other one is the proposal to reduce the tax rate for the digital asset tax from 3% to 1.5% of the transfer or exchange value of the digital asset. This one was just to align it, I think, with the TOT and to make sure that even with the turnover tax, but also to ensure that more people pay tax. It's been reduced so that more people are in the formal system of so that they don't go to the black markets when it comes to issues of digital tax. Many of it are formalized, if I can say. Another one is the introduction of advanced pricing agreements. This one is a proposal that to provide that the commissioner may enter into advanced pricing agreements with a multinational company having a permanent establishment in Kenya. So these advanced pricing agreements are agreements between a taxpayer and the commissioner that predetermine the appropriate transfer pricing method for transactions between related parties over a fixed period. So it will give certainty and also enhance compliance and also just help us to just reduce litigation and all that. It's an agreement. So the other amendment is to the proposed amendment is to amend the terminology related to life insurance from life fund to life insurance fund. The term life fund is used in the Income Tax Act, but the definition is that of the life insurance fund, which is in Section 19(7). So there's a bit of confusion there, the inconsistency in the use of terms. So it's more like a cleanup. So the other one is to removal of the defined term gross investment receipts. This one is also redundant, which is in respect of trade associations and members clubs. It's a consequential amendment so that it's aligned with the changes that were made in the taxation of members, clubs, and trade associations under the Finance Act 2023. The Finance Act 2023 removed the conditions for taxing members club or trade association on the ratio of income from member subscription. So there's no need of retaining the definition of the gross investment receipts. And then there is also the Finance Bill 2025 proposes to introduce an obligation on the commissioner to respond to applications for change in accounting periods for a company within 6 months. So failure to which the same stands granted by law. So this one is just to ensure that the commissioner responds on time. If the commissioner does not respond when a taxpayer seeks change in accounting periods, then it means the issue stands. It is granted. It's automatically changed after 6 months. So it's a proposal. The other proposal is to subject profits and gains by non-resident ship owners and charterers to withholding tax. So, the gross amount received on account of carriage and those gains or profits are deemed to be income derived from Kenya. But the Income Tax Act does not does not guide expressly on that, on how the tax should be levied and when it should be paid. So the bill proposes to provide that the tax should be collected as withholding tax and remitted to the commissioner within 5 working days after being withheld. So that is just to clarify that. The next proposal is to delete provisions relating to objections and security of taxes under the Income Tax Act, because they're already provided in the TPA. So those ones are more of a cleanup. Any provisions under the Income Tax Act that were transferred to the Tax Procedures Act, those ones are being deleted. Like I think Section 35(6)(a), which provides for penalties for not withholding tax on capital gains tax. That one is already under the TPA. Objections against tax assessments, Section 6, capital E, subsection 35(6)(e). Those ones, all of them were moved to the TPA, so there's need to delete that under the Income Tax Act. The other proposal is to clarify that employers are required to provide employees with reliefs and deductions. So this one, the Income Tax Act already provides for employers to allow these deductions that employees qualify for when they're completing the pay as you earn. But still, there are many employers who do not deduct these reliefs. So this is just to now, and actually, because there are so many claims for refunds from taxpayers, probably because they were not deducted, these reliefs or deductions or exemptions when it was due. So just to reduce these refunds, this so that it also the processing is hastened, the bill proposes to compel employers to grant employees these deductions, the applicable ones, and tax reliefs while computing on an individual income. So this will also assist the Revenue Authority to just also on the issue of refunds. The other proposal is to just to remove the need to supply the commissioner with a certificate on payment for emoluments by employers. So, everything now is digitized on iTax. It's automated, and therefore it does not require that issuing of certificates by the employer. So also submission of returns to the commissioner for payee and other returns is done electronically. So the law had not been amended to reflect this. So this is what is happening, just to remove that. Also, the requirement to include details, the proposal to include requirements to include the details of any any dividend distributed out of untaxed gains in a particular year of income in the tax return. That one is under Section 52B. The term compensating tax was repealed, so it's being replaced with the word dividend distributed out of untaxed gains in that particular year. The other proposal is to delete provisions relating to supply of information upon change in particulars, because this is already provided for under the TPA, so it's more of a cleanup. Also, the penalty for understatement of installment tax removed. Most of the penalties, all of them, some were provided in the Tax Procedures Act. So there's need to remove them from the Income Tax Act so that it's addressed under the Tax Procedures Act. Also, there's a proposal to extend the time frame for processing of exemption certificates application, which is currently at 60 days to 90 days under paragraph 10 of the first schedule. This is mostly because KRA requires, I think, more time for processing. The 60 days is not sufficient given the number of applications received by the office. So increasing the number of days to 90 will allow for a comprehensive review of applications in line with the law. And recently there was a law that was enacted, which is the income tax in brackets charitable organizations and donations exemption rules 2024. So to basically to guide that process of application of processing the exemptions. So it's also a proposal. Another proposed amendment is replacing the National Insurance Fund with the Social Health Insurance Fund, so that to ensure contributions made to the fund and payments out of the fund are exempt. This one is just because the first schedule has the word National Hospital Insurance Fund, and NHIF was replaced by SHIF with effect from 1st October 2024. So the income tax is proposed to be amendment to also just reflect that change, and also just to ensure that the income of social health insurance fund is exempt from tax. The other proposal is to exemption of gratuity. This one, the Tax Laws Amendments Act 2024 amended the Income Act to exempt the Income Tax Act, to exempt from tax the gratuity paid from a public pension fund. And at that point, it was not clear whether also the gratuity from private pension schemes were also exempt. So this provision is not clear that the exemption of gratuity is for both for public and for private pension schemes. So the bill proposes to just clarify that gratuity payment, whether it's from a public or from a private scheme, are both exempt from tax. So it's also like a cleanup. And then also another proposal is to delete the exemption that currently excludes compensating tax accruing to a company undertaking the manufacture of human vaccines from taxation. Okay, Mindy, we can move to the next one. The next proposed amendment is to clarify that only gains on transfer of property within an SEZ by a licensed SEZ developer, operator, or enterprise qualify for exemption from capital gains tax. So last year, the Special Economic Zones Act was amended to provide for the coexistence of both customs controlled areas where tax incentives apply and where non-custom controlled areas where tax incentives do not apply. And the accelerated investment deduction of 100% is provided for both the SEZ, the Special Economic Zone, and the non-Special Economic Zone enterprises, developers and operators. So they enjoy this benefit, and that benefit is not meant for the non-Special Economic Zone entities. So this is unfair because entities outside the SEZ or the Special Economic Zones do not get the tax treatment, but rather they deduct investment allowance over a period of time. To rectify this, the Finance Bill 2025 proposes to restrict that incentive granted to special economic zones to apply only to licensed special economic zone developers, operators, and enterprises, as opposed to the zone. So it will close that loophole and allow businesses outside the licensed SEZs or in unintended areas to claim the incentive, leading to to just basically close that loophole so that they don't abuse that policy. The next proposed amendment is on exemption of gains on transfer of securities traded in any securities exchange approved by the CMA. So this is under the first schedule to the Income Tax Act. There's that proposal to exempt. Already that provision was there, but unfortunately it was put under the third schedule. And the third schedule deals with rates of tax and even the rates of the reliefs. So it was there, but it was supposed to be an exemption, and exemptions are under the first schedule. So this one is just being deleted from the third schedule and being brought to the first schedule, so that any gains on transfer of securities traded in securities exchange, which are approved by the Capital Markets Authority, are exempt. The other proposed amendment, is to exempt dividends paid by the Nairobi International Financial Center Authority certified companies, NIFCA, where that company reinvests at least 250 million shillings in Kenya in that year of income. This is to promote trade, is it financial, foreign direct investment in the country. So the other proposal also is to remove the 100% and the 150% investment deductions provided for investment outside Nairobi City County and Mombasa County on hotel buildings and buildings used for manufacture. And it's because of the tax expenditure issue, but also it's also a bit discriminatory because now we have more cities. I think when this act was put, there were only 2 cities. When this provision was put, there were only 2 cities, but now we have more cities. And also, it gives undue advantage to investment, which cannot in their nature be located in the cities. For example, the extractive industries or agricultural processing industries. So to ensure that there's this fair treatment of all investors, there's that proposal to delete that provision. The other proposed amendment is also to reduce tax expenditure in line with the national tax policy and the medium tax revenue strategy. There's that proposal to remove preferential rate of tax for those 2 entities, construction of up to 100 residential units, and also for entities that assemble motor vehicles locally. So it's a proposal. Also, another proposed amendment is the introduction of a lower corporate income tax rate for startups that are certified by Nairobi International Financial Center Authority, to be 15% for the first 3 years and 20% for the succeeding 4 years. So the bill, as proposed, various incentives aimed at attracting investment through NIFCA. So because the government wants to strengthen Kenya's position as a regional financial hub and also to promote foreign direct investment. So the NIFCA certified investors, multinational and startups, have several incentives there, as you can see. One of them is what I've just read, that any startups, of course, there are conditions there that are listed, that are those startups certified by NIFCA to enjoy a reduced corporation tax rate. And also, there are others, I think, in the bill, which we've not listed there. Like the bill proposes that dividends earned by the certified holding companies in regional headquarters to be exempt from tax, provided they reinvest at least 250 million. And that one I'd already read it, so it's okay. So those ones are under NIFCA. The next proposal is to clarify that withholding tax deducted on qualifying dividends and qualifying interest earned by resident person shall be treated as a final tax. That one, and then the next proposal, I think the Tax Laws Amendments Act had amended Section 34, it repealed Section 34 of the Income Tax Act, which led to a bit of it created a gap there on the issue of fringe benefits and also on the qualifying dividends and qualifying interest. So this proposal is basically aimed to correct that and to to just clarify that withholding tax is deducted on qualifying dividends and qualifying interest and at final tax. And for fringe benefits, it's at the corporate tax rate for the year of income, so that there's no gap. Mindy, I don't know whether that was the last proposal under the Income Tax Act.
I trust it was, and I think we can now move to VAT. I think Madam Polly Kifui, thank you very much, Monica, for that. In the interest of time, Polly, maybe I can request you to perhaps move along this presentation. I know ITA was the longest, so maybe we can proceed a little quickly. And in advance, I can maybe request those who've managed to join to give us an allowance of an additional 5 to 10 minutes maximum so that we can cover the presentations we've planned for today. Additionally, we welcome you to post questions, comments, and concerns in the chat. We have a number of officers on standby who can assist with that, also in the interest of time to save time towards the end. Thanks, Monica, again, and over to you, Polly.
Thank you, Mindy. Confirm you can hear me.
Loud and clear. Thanks.
Okay, thank you. My name is Polly Kibu. I'm going to take you through the proposed amendments in the Finance Bill 2025. And the first one is to introduce a definition in the VAT Act of a tax invoice, what tax invoice is. Currently, the VAT Act has no definition for tax invoice, so the bill is proposing to introduce a definition that aligns with what is provided in the Tax Procedures Act, Section 23A, and is to read that the tax invoice includes an electronic tax invoice issued in accordance with Section 23A of the TPA. So the next proposed amendment is to remove, there's an ambiguity currently in Section 8 of the VAT Act as to how we treat imported broadcasting and radio services. So the bill now is proposing to make it clear that those services are electronic services, and so they'll be treated in the same way that electronic services are treated under Section 5(7) of the VAT Act. So the next proposed amendment by the Finance Bill is that it proposes to align the period for lodging VAT refunds claim on excess tax to 12 months to align with the one that is provided in the TPA, the timeline provided for lodging refunds on overpaid tax. That is 12 months in the TPA. So just aligning the timelines. So the next amendment is to reduce the timeline or the time for lodging VAT refunds for tax on bad debt from 3 years. Currently you can lodge after 3 years to 2 years. So it's just reducing that timeline. The next amendment is still on Section 31 of the VAT Act, is to provide that this refund that which is if granted by the Commission on tax on bad debt, you can also apply it on outstanding VAT liabilities as well as future. So currently it only provides that you can utilize that VAT refund to offset future liabilities. So now it's providing that you can also utilize that VAT refund to offset outstanding, but it's subject to the approval of the Commissioner. Then the next proposed amendment by the Finance Bill 2025 is to provide under Section 42 of the VAT Act, that registered persons can issue tax invoices for both taxable supplies as well as exempt supplies. So currently, Section 42 provides that our registered persons will issue tax invoices for only taxable supplies. So this has bring a lot of reconciliation issues where, especially when people are filing the income tax returns, when you compare that with the VAT return, you always find there are differences, and which is mostly as a result that invoices were not issued for the exempt supplies. So the bill is now proposing to provide that invoices be issued for exempt supplies. So the next proposed amendment is to introduce a provision 66A in the VAT Act to impose VAT where supplies initially acquired as exempt or zero-rated, if they are disposed in a manner that is inconsistent with the intended purpose, the VAT will be due. Because you find that under the first schedule and second schedule, there's some exemptions or zero rating that are granted subject to some condition, that those supplies or those inputs or raw materials are utilized in a certain manner, or production or manufacture of a certain product. But should they be disposed or utilized in a manner that is not consistent with that exemption for which the exemption was granted, then VAT will be due. That is the proposed amendment by way of introduction of a new section 66A, the VAT Act. And we can move. So there are various, the bill has proposed to move some items from being exempt or zero rated to taxable, or from zero rate to exempt, just to reduce the tax expenditure. And that is the main reason why this movement is being made, and also to align with the international best practice, and also to seek to have zero-rated status just apply to exports. So I think I'm going to go through this very fast because there are quite a number. So under paragraph 49, all goods and parts thereof of chapter 88, now they're proposed to be taxable. Currently, they are exempt. Fuels, lubricants, and tires for vehicles used for the implementation of official aid funded projects are proposed to be taxable at 16%. They are currently exempt. Direction finding compasses, instruments, and appliances for aircraft proposed to be taxable. Taxable goods for direct and exclusive use for the construction of tourism facilities, recreational parks of 50 acres and more are proposed to be taxable, but there is a transition clause that provides that the exemption should run until 30th June 2026. So it will not be like it will take effect. The exemption will take the change will take effect for those ones that are being granted exemption on 30th June 2026. So you can note there is a transition clause for that, as well as taxable goods for direct and exclusive use in the construction and equipment of specialized hospitals. Also, there is a transition clause for that. The exemption for those that have been granted will end on 30th June 2026. Specifically designed locally assembled motor vehicles for transportation of tourists are proposed to be taxable. So the following items are proposed to be taxable, but for the ones which exemptions has already been granted, it will run up to 30th June 2026, which this include goods imported or purchased locally for the direct and exclusive use in the construction of affordable houses. Taxable goods excluding motor vehicles imported or purchased for direct and exclusive use in geothermal, oil, or mining prospecting, and specialized equipment for the development and generation of solar and wind energy. So there are some items here: discs, tapes, smart cards also proposed to be taxable. But should there be if the ones that have already been granted exemptions, that exemption will run up until 30th June 2026. Weighing machinery of that tariff number 842310 also proposed to be taxable, but if there are some that have been granted exemption, it will run up to 30th June 2026. Inputs and raw materials for the manufacture of passenger motor vehicles are proposed to be taxable. Locally manufactured passenger motor vehicles also proposed to be taxable. Inputs or raw materials, either locally produced or imported, supplied to pharmaceutical manufacturers in Kenya for the manufacture of medicaments, are proposed to be exempt. These are currently under the zero rated, and you find that medicaments are exempt. So this is just aligning the two, that the medicaments on one hand are exempt, and also the inputs now become exempt. It currently misaligned that the inputs are zero rate, while the output, which are the medicaments, are exempt. So it's just aligning the two to the exempt status. So inputs or raw materials for locally purchased or produced for manufacture of animal feeds also are proposed to be exempt. They are currently zero rated. So this is the same as the medicaments because the animal feeds are exempt. So there's been a mismatch where the inputs on one hand are zero rated and the animal feeds are exempt. So now the bill is coming to align the two to the exempt status, the inputs as well as the output, which are the animal feeds. So transportation of sugar from farm to milling factories also supposed to be exempt. Currently, it's at zero rate. Supply of locally assembled and manufactured mobile phones proposed to be exempt. Currently, they are zero rated. Supply of electric motor vehicles, because that tariff number 871160 is for electric motorcycles, They are proposed to move from the zero rate status to exempt. Supply of electric bicycles, as well as their batteries, which are these solar and lithium ion batteries, are proposed to move from the zero rate to the exempt status. Supply of electric buses of heading 8702 are proposed to move from zero rate to exempt status, as well as the bioethanol vapor stoves, which are currently zero rate. They are proposed to be moved to the exempt status. Packaging of batteries for tea and coffee, these ones are proposed to be exempt. Currently, they are taxable at 16%. I think that brings us to the end of the presentation on VAT. So back to you, Mandy, for the presentation on excise duty.
Asante sana, Madam Polly. Thank you so much, and thank you for keeping good time. I'd like to now welcome Madam Jane Mugosho. Karibu sana and good morning. I'll also request if you can just keep it brief for excise-related amendments, and then we'll proceed to the TP as we wind up. Thank you. We continue to invite members to post questions, comments, and concerns, and they'll be addressed time permitting towards the end. Karibu sana, Madam Jane.
Mandy, Jen just sent me a message that she had to go to another meeting, so I'll step in briefly. I noticed excess duty is small, so we'll go directly to the proposals under the Excess Duty Act. So the first one is to review the definition of digital lender. This one was already in the Tax Laws Amendments Act, but had some. It was not covering, I think, those ones that are not registered with the Central Bank of Kenya. So currently, there's a proposal to amend Section 2 of the Excess Duty to define a digital lender as a person extending credit through electronic media, but does not include a bank licensed under the Banking Act, a SACCO registered under the Cooperative Societies Act, or a microfinance institution that is licensed under the Microfinance Act. The other proposal is to introduce the definition of a digital marketplace under the Excess Duty Act. I think there's a definition under the VAT Act, but the Excess Duty Act is not clear on this. So the term digital marketplace is broad, and it includes services that are provided through the internet or an electronic network. So basically, this is just to widen the scope. The other one is to provide the proposal to provide for classification of goods by the EAC tariff code. So this one is just to provide for that classification. There's a similar provision under also the VAT Act, just to confirm that what applies is the EAC CT common tariffs, and it will be interpreted in accordance with the rules of that interpretation then when we are classifying goods under the Excess Duty Act. So the next proposal is to provide for the definition of non-resident person under the Excise Duty Act, and also to broaden the scope in respect of accessible services to be included, to include services offered through the internet or an electronic network. The other proposal is where the supplier's place of business is outside Kenya, a supply of accessible services shall be deemed to be supplied in Kenya if the services are consumed or used in Kenya. So this one is just to clarify that. It's like deeming that income here in Kenya. So there's a gap there that needs to be filled under the Excise Duty Act. The next proposal is to introduce that 14-day timeline for the commissioner to consider a license application. So the bill proposes to provide that the commissioner should approve or deny an application for excise duty license within 14 days upon receiving all the valid documents. So currently there's no timeline. So for of processing excise license applications, which sometimes leads to delays and uncertainty for businesses. So so that is it. The next proposal is to change the taxable value of coal from its customs value to its accessible value. The Excise Duty Act talks about the value should be accessible value, I think Section 9. So when the tax on coal came in under the tax laws, it was not, it was put as customs value. So that is just changing it, cleaning it to accessible value. So the others are the rates of tax that have been proposed to be amended under the Excise Duty Act. The first one for coal is not really changing rate. We're only changing that value. The value computation should be on accessible value, not customs value. Imported float glass, surface ground, or polished glass in sheets. This one is also a cleanup because the word whichever is higher was not there. So it was not clear whether whichever rate to apply, 35% or 200 per kilogram. Also for imported self-adhesive plastic sheets, films, etc. That one is also just to make it clear. I think two rates had been provided, so now it's clear that it's the 25% of accessible value or 200 shillings per kilogram, whichever is higher. The next one is an imported printed polymers of ethylene of that tariff. So the current rate is there's no current rate provided there. So it's proposed to be introduced at 25% of accessible value or 200 shillings, whichever is higher. Also for printed polymers of vinyl chloride of that tariffed, imported printed poly of that tariffed, imported printed cellular plastics, and also printed self-adhesive paper of those tariff lines, all of them at 25% of the accessible value or 200 shillings per kilogram, whichever is higher. Also, finally, also spirits of undenatured extra neutral alcohol of alcoholic strength exceeding 90%. This one is a raw material in the production of alcohol. So the proposal is to provide for excise duty rate at the rate of 500 shillings per litre on that of alcoholic strength exceeding 90%, which is purchased by licensed manufacturers of spirituous beverages. So it's a raw material, and therefore there's no need to tax it at the current rate, which is a bit more high for them. Thank you.
All right. Thank you very much, Madam Monica, for stepping in. We appreciate it and also for keeping time. I know Mr. Nyangweso has not been able to join in regards to the TPA presentation. Assuming I got it right that he was to take us through the miscellaneous and the TPA. Maybe if you don't mind, if you to guide us on who might conclude for us.
Mindy, unfortunately, had not communicated, but can I just give me 1 minute? I check whether he's able to join. Within 1 minute.
All right, no problem. Thank you.
Okay.
Thanks, Madam Monica, and to our esteemed participants who managed to join the session. Thank you very much. Thanks, Mr. Ore, also for being on standby to assist with the Q&A. I note we only have a question that has come in, one question that's coming from Anna Vonde from NTA. And if you don't mind, Mr. Ore, if you're in a position to unmute, just clarify the significance of the zero rating and exempt status for VAT goods and services. What does that mean exactly? Mr. Ore?
Mindy.
Oh, thanks, Monica. Yes.
Sorry, what was the name? I was talking to Josiah, and he confirmed that he's just logging in now because
no worries,
he's meeting.
Monica. Yes,
His
yes.
meeting has just ended.
We were just
There's
making
something
some
you were
time.
saying about Aure? Because I noticed.
There was one question that's been able to come in. One question has been able to come in as we were awaiting additional comments. So maybe Mr. Aure or Polly rather can chime in on that. Thank you.
So thank you, Mandy. So I think Anne is asking for a clarification on what exemption and zero rating mean. I believe this is with respect to VAT. So when a good or rather when a supply is exempt, what it means is that no VAT is charged. So like the supplies in the first schedule to the VAT Act, it means that there will not be VAT. But now when we talk about zero rating, what this means is that VAT is charged, but at a zero rate. You know the standard rate for VAT is 16%. That is what is always charged. But there are goods which are listed or there are supplies which are listed in the second schedule to the VAT Act with a preferential VAT rate. And the preferential VAT rate here is 0. So that's what the difference is between exemption under the first schedule to the VAT Act and zero rating under the second schedule to the VAT Act. Thank you.
Perfect. Perfect. Thanks, Mr. Aure. Madam Anne, if you have a follow-up, feel free to post that in the chat. We'll await Mr. Josiah to join us. In the meantime, in case anyone has a question, comment, or concern, we'd requested a bit earlier if you could allow us an additional 5 to 10 minutes so that we can handle the final presentation. And then there being no additional questions or concerns, we can wind up. So allow me again just to request your patience as we await one of our final presenters, Mr. Nyangasa, to join, and then we'll start. All right, perfect. Mr. Nyangweso, thank you for managing to join this session. I know you had another engagement, and we appreciate you making the time to participate and sensitize us on the TPA and the miscellaneous the amendments that are being proposed in those two acts. So, karibu sana, Mr. Nyangweso. If possible, I kindly request if you can summarize the two acts and wind up within 10 minutes thereabouts so that we can save the last 5 for Q&A and wind up. Thanks and good morning to you. Mr. Nyagaso, kindly confirm if you can hear us. On our end, we're unable to hear you, though we note you've been during the session and can unmute. All right, Mr. Nyangweso, I'm not sure if you're able to unmute. Allow me to request Anne to give Josiah Nyangweso co-host rights to be able to unmute on his own. Thanks, sir. We'll resolve that shortly. Anne? Thank you very much. Mr. Nyangweso, I think you're now good to go. Good morning to you, sir.
Yes, good morning. Sorry, I've been in another meeting. We can be able to proceed on the proposed amendments in the Finance Bill 2025. So the first proposal is proposing to define the categories of transactions that may be excluded from the requirement to issue electronic tax invoices. For clarity, this amendment was already provided for through the Tax Procedures Amendment Act of 2024, but it lacked some clarity on those transactions. So generally, the amendment is just a cleanup. The second amendment is proposing to introduce an additional requirement on the part of the commissioner to provide lessons where there are amended assessments, especially on the original assessments, self-assessments by the taxpayer. This is in line not only with the Constitution, that is Article 47, but also with the Fair Administration of Actions Act. Then the third amendment is proposing to provide relief from withholding tax liability and cases where the recipient has already paid and accounted for the full principal taxes together with the tax that had not been deducted by the withholding tax agent. We have had cases where the agents, for one reason or another, are not able to, or they do not withhold and limit the taxes as required, but the recipients of the payments fully account for that. And since the local entry does not provide for relief, we find that the staff still demand not only for the principal taxes, but also the penalty for failure to withhold and deduct from that particular agent. So this is meant to remedy that challenge. The fourth amendment is exemption from stamp duty of transactions for transfer of property where those properties have been used to secure and pay taxes during disposal. These are cases where the commissioner has issued restraint to the registrar at the Ministry of Lands and for security of the property for the unpaid taxes. So what we are proposing is that such transactions will be exempted from stamp duty because this process is for public interest purposes. It is meant to reduce the cost of tax administration. And the fifth amendment is to Section 42 of the Tax Procedures Act. And it's meant to grant the commissioner powers to collect tax from non-resident persons who are subject to tax in Kenya, where now the commissioner can be able to use the agency notice model to collect taxes from such non-resident persons, especially those ones who have business interests in Kenya and are actively involved in business and drawing income from Kenya. Then the next amendment, I think, is similar. Next, we have issuance of agents notices where judgment is in favor of commissioner even when the taxpayers are billed against the assessment specified in a decision of the tax appeals tribunal or of the higher courts. What we have witnessed is that under the current legal framework, once the commissioner obtains judgment in his favor at the tax appeals tribunal or in the high court, and the appellant who had filed the case further appeals to the subsequent court, but does not obtain stay orders for such judgment, they still stop us from enforcing any correction. So the purpose of this amendment is to ensure that the commissioner can benefit from the results of a judgment, especially in cases where stay orders have not been granted by the court. In cases where the stay orders have been granted, then the commissioner will hold enforcement. But where those orders have not been granted, then the commissioner can be able to proceed and correct. Next, we have the removal of the requirement for conviction before imposition of penalty for failure to withhold or limit withholding VAT. Currently, the provision provides for failure for imposition of a penalty for failure to withhold, but there is also the element of failure to submit the return. So the proposal in the bill is a cleanup to ensure that both circumstances of failure to remit and failure to submit the returns are covered. Next, we have repeal of the Commissioner's powers to appoint agents for correction and remittance of digital service tax. This is a cleanup to align with amendments which were introduced through the Tax Laws Amendment Act of 2024, where this particular tax was repealed. Next, we have extension of period within which Commissioner must sustain refunds for cases that do not require audit. This is being extended from 90 days to 120, and those which require audit from 120 days to 180 days to give the Commissioner adequate time to review these cases. Next, we have clarification on commencement of objection decision timeline for rate objections. Currently, we do not have certainty on when to start counting when a taxpayer lodges a rate objection and the commissioner aroused that late objection. So the question was whether that timeline should start counting from the date the commissioner aroused the objection or from the date the original objection was lodged. So this is a cleanup for clarification by introduction of a new sections 51 subsection 7 capital B, so that it is clear. And the next amendment is removal of the limitation to integrate or share data, which was introduced through Tax Procedures Amendment Act of 2024. This particular amendment prohibited the commissioner from sharing personal data relating to trade secrets, which carrier holds. So this will allow us to have an effective tax administration system which does not have this limitation. And the next, we have an amendment, section 77 of the Tax Procedures Act to provide for a uniform timeline for handling tax matters. The amendment that was introduced in 2024 introduced some administration challenges where we had excluded computation of time for weekends and public holidays. So the current amendment is to remove such amendment, and the reason given is that the tax administration systems have been automated to ensure that the taxpayers can be able to access services from any time of the week, and therefore this ensures certainty in administering the tax system and also computation of time for purposes of taxes. And lastly, we have proposed amendment to grant the CS Treasury powers to waive interest and penalties with some specific references to circumstances under which that waiver can be granted, especially where there are errors in the tax records, where there is a delay in updating the system, especially when there are change of tax rates, or where there is a malfunction of the system, and the errors are noted and the system generates those penalties and interest. We also have instances where there is incorrect registration of tax applications of a taxpayer. For instance, taxpayer is registered for individual income tax purposes, but given another additional incorrect registration for VAT. So we find that the system will generate interest and penalties for such incorrect obligations, and there is no provision currently which can allow for waiver of those interests and penalties. This is just a reintroduction of the provisions of Section 89, 6, 7, and 8 that had been built through the Finance Act of 2023. So next, we have the provisions proposing amendment to the miscellaneous fees and levies. The first one is to remove the restriction that had been introduced on the application of Tax Procedures Act to specific refund applications to allow the application of the Tax Procedures Act in enforcement of the Miscellaneous Fees and Levies Act. So what is being amended is just to remove that restriction, which was witnessed in this section, because it's restricted to that particular section alone instead of application throughout the provisions of the Miscellaneous Fees and Levies Act. Next, we have the deletion of the exemptions from IDF and Railway Development Levy for all goods and parts of Chapter 88 of the HS. So this amendment is restricted to the specific tariff numbers which are included in the finance bill, and it's meant to clarify which goods are exempt. Next, we have the list of 3 products where we have a reduction in export and investment promotion levy from 17.5% to 10%. That is the 3 goods for the 3 listed tariff numbers. I think that brings me to the end of this presentation. But from the proposed amendment on the Stamp Duty Act to exempt transfer of property by a company that is shareholders as part of an internal organization as one of the proposals which is to be considered through this finance bill.
All right. Thank you very much. Thank you very much, sir, for making the time once again and for taking us through those 2 proposals. Those 2 amended proposals in the amended act. We don't take it for granted. And a big thank you to the entire team. We've gone way past time. And so before I hand it over to you, maybe I can just open the floor for 1 minute in case an attendee would like to post a question in the chat and the panel can respond. Just the next 1 minute, and then we'll wind up. As we await additional questions, a big thank you to the various CMs who managed to join us, the chief managers from our policy department, Madam Mary Ansela, I know Madam Lena was here a bit earlier, Mr. Julius Siega, and the entire policy team. Thank you, and the budget team. We don't take it for granted, you making the time to be here and engaging with our key stakeholders, that is the taxpayers. Since we have no further questions, I'll hand it over back to you, Anne, to close us off. And thank you again for the opportunity. Anne, kindly confirm if you can hear us. We can hand it over back to you. Thank you. All right, perhaps Madam Anne from the National Tax.
Hello.
Oh, perfect. All right. Yes, thank you.
I was having an internet issue. Let me see, was unable to unmute myself, but now I think you can hear me, right?
Yes.
Can you hear me?
Yes.
Thank you very much to the KRA team. And I would like everyone to react by like giving them flowers, clapping for them, or also like you can use the reaction tab on the screen so that we can give them like an appreciation of what they have done. This is a great job. I'm waiting to see people reacting.
And before we finish,
Yes.
will there be a room for at least one more question? Okay, thank you for the.
I can't hear you, Boniface.
I'm looking for want to ask a question. I don't know. Can you hear me now?
Yes, I can hear you.
Okay, to the team, we are very grateful for the education. This is very important so that we are able to at least to segment issues and to master these sensitive areas. When the dispatch came from the cabinet some weeks ago, before now the bill came up, the conversation was no new taxes, and also reading at the targets that the government has set, or in this case the Treasury has set in terms of revenue mobilization for the coming financial year, and looking at now the document as it is, we are trying to think in terms of how does it impact indirect taxes that sometimes maybe borrowing from the previous account where maybe we see VAT to this item increasing from this, for example, when we had petroleum from 8 to 16. It is silent on that. So we are trying to think in terms of what is the implication of shifting from what, zero rating to exemption. Does it have implication on indirect or tax increments, especially to the end consumers? That is one. The other one, there has been a challenge of unmet revenue targets every year, most of the recurrences. How does it help to address revenue and administration efficiency in regards to meeting the revenue targets? Maybe you could help us dissect those two. Santi.
All right, perfect. Thank you, Mr. Karanja. We always appreciate and welcome questions. In the interest of time, we'll make that the only question we can handle at this point, but NTA can, of course, forward any additional comments or concerns that arise from the session. Madam Monica, with your guidance, maybe we can request Polly to respond to the question on the implications on the final consumer, if any, from removing a good from zero rated to exempt status. And perhaps anyone else from the session can comment on some of the revenue mobilization enhancements towards efficiency that will help achieving the target that is yet to be set. Polly?
Thank you. There was a question. I'll respond to the question on the change of status, how then it affects the mwananchi, whether there will be an increase in prices. Okay, now the reason for the change of Mandy, you muted me?
No, Polly, sorry, I can hear you. I can hear you.
All right.
I think there's a little
reason,
background noise, but we can hear you. Thank you.
just let me take care of that a minute. Okay, sorry for that. So the reason for the change, of course, was to reduce pressure. Also, besides reducing tax expenditure, it was also to reduce the pressure that refunds when these products or items under the zero rate status, there's a lot of refunds claims that are made. So the government is also looking to reduce that pressure on refunds. Now, will there be change in prices because of the change of the status from zero rate to exempt status? That is to be seen. We'll see how the manufacturers react, because now they'll not be able to claim the input tax. Now, where do they take the input tax? Now, we cannot speculate at this point, but it's something we'll be looking and watching out for, because even sometimes when we change these goods from exempt to zero, we find the prices, there's no reduction in prices. So we are waiting to see how then the manufacturers respond to this status change. So I cannot at this point speculate on how the market is going to react. But that is a proposal that is there. So if there is need to, is this concern being raised, it can be raised. There is the avenue of raising it to the National Assembly. If there is concern that prices might change, there's that avenue of stakeholder participation where this can also, this concern can be raised. But right now, for where I sit, I cannot speculate on how it was going to affect the prices in the market. Thank you, Mindy.
Asante sana, Madam Polly, for the comment on indirect taxes. Maybe Monica or anyone else from the team, if you're in a position to touch on the issue to do with how some of the proposals in the bill are aiding in efficiency and effectiveness in meeting our upcoming targets. Thank you.
Anyangoso, I don't know whether you have something to say about that.
Yes, in regard to that question on how these proposals will help in meeting the revenue target, is that the intention was to streamline the processes for tax administration, especially cleaning up the law to ensure certainty in especially issues to do with timelines, because in the past we have witnessed tax disputes, some based on issues of time, and clarity of timelines will then minimize litigation and ensure that we correct the due taxes on time, instead of engaging in protracted litigation for a long time in the courts. Secondly, the proposals in this bill, as has been highlighted, do not propose new taxes. The proposals are meant to encourage and enhance compliance, and where there are justifiable reasons, as you saw, provisions for exemptions as well as waiver have been made. So any taxpayer will have any justifiable reason why they need to receive specific waivers. They can be able to apply. This creates an harmonious relationship between tax administration and the taxpayers. In nurturing that relationship, so that we can be able to correct the taxes that are payable in the time that we are required to correct it. So we believe that these proposals, which have been made, can be able to improve tax efficiency and effectiveness, in the end, resulting into more revenue even without the additional taxes being proposed or higher rates being proposed. Thank you.
Asante sana, sir. Thank you for that comment, those comments. We'll hand it over back to you, Anne. Once again, appreciating the NTA team and all those who've managed to join, and appreciating them for their time. Thank you, and back to you.
Note Mandy and your team. Before we close, I would like to ask, what are the implications when we are saying that we are being granted tax incentives or investment promotion? Are we not going to lose revenue in terms of tax loss?
Sorry, Anne, the question was not clear.
When we are granting tax incentives for investments, as well as investment promotion levies, are we not opening avenues for loss of tax revenue in terms of incentives and investment promotion levies?
All right, thanks for that question. Perhaps, again, that will be the last question we can handle in the interest of time, Anne. But Monica, you can chime in as well, perhaps within the context of balancing, the various socioeconomic and political considerations one must make when it comes to designing an effective tax policy. But Monica, feel free to comment if you have briefly.
Thank you, Mandy. And as you have rightly put it, I think it's an issue of balancing. I think it's, as you noticed, most of the proposals that were put in place, most of them were to reduce tax expenditure. But there are those targeted ones that are, just for example, the ones that I talked about for NIFCA, that was aimed to attract foreign direct investment, which is a good thing, which in the long run will help us also just get this, because there are those conditions. It's not just that it's an open incentive. There are those you have to, for instance, as we say, you have to invest at least 250 million. So that one is just meant to, it's targeted. It's not open. Yes, the intention of the national tax policy is, and the emphasis is to reduce. But there are specific areas that needs to be encouraged. Over to you. Thank you.
Perfect. Thank you very much, Madam Monica, for those comments. And with that, Anne, we appreciate you and wish you a blessed rest of the day and your entire team.
Thanks everyone who managed to attend this meeting. I would like to welcome Cynthia so that she can tell us that there are those some of us who don't know what National Taxpayers Association means. And when we started the meeting, we didn't have a bit of intro. So Cynthia, I welcome you so that you can give a bit of introduction concerning National Taxpayers Association, so that those members who attended today and they have never interacted with NTA, they can understand why we had this meeting and why are we here discussing matters on Finance Bill 2025, as we all know that everyone is a taxpayer. Back to you, Cynthia.
With your permission, Anne, allow me to please request a number of officers in the forum who might have to step out for another engagement, as this is a busy time within the organization. So with your permission, Anne, just before Cynthia comes on, please allow us a number of officers to step out from KRA. Thank you.
Thank you. This is well noted.
Okay, thank you, Anne. Thank you from the KRA team as well. Am I audible?
Yes, I can hear you, Cynthia.
Oh, okay, perfect. Thank you again for the wonderful forum. We've been able to unpack what the finance bill means for us. So my name is Cynthia Mwanda, under the programs department. At NTA, we advocate for government accountability and delivery of services, and we aim to influence policy through engagements and partnerships and transform taxpayers' information, and we also conduct research. So that's why we are very interested in tax, because that's our core mandate, because we want to have a taxpayer responsive government so that they can deliver quality services. So thanks again. I don't want to go on. I think we've unpacked what the finance bill means for us, and thank you again for the forum.
Thank you, everyone who attended. Now the meeting comes to an end, and you can leave at your own pleasure. Have a nice and lovely day.